Thanks very much for inviting me here. I love talking about money. Funnily enough, I don't actually get to talk about it very much in my current role, which might surprise people, but council, I'm not going to talk about council tonight, thank God. Right. So I'm going to actually go very high here and actually talk about global markets and some of my experiences in global markets, and then hopefully I will bring it down to ground level to the investing piece by the end. So I started out trading stocks. Actually, it's not even what I want to talk a little bit about tonight is the difference between trading and investing, because they're two very, very different things. So I did my first stock trade, I think in 1985, nearly 35 years ago. So I've been around this game for a long time. And it was when I was at university. And I don't know if anyone remembers the UK back then, but there was a lot of privatizations going on. And, some inspiring friends got together with me, and we actually went around lecture halls paying people to sign up to buy shares in like British Gas and British Telecom and all that stuff. And then we'd stag it, and obviously then we'd sell it when the shares floated and make a bit of money. It was very enterprising at the time. But the entry into the stock market back then was really not so much about long-term investment, but actually buying and selling, and everything was focused around the enormous profits that were made from privatization, which we've sort of seen a little bit of here with the energy and utilities floats over the last few years, which have actually been very good for investors, but less stagging, which is what we saw in the 1980s. So it was still very new investing to the public. So I traded a bit when I was at university. When I came out of university in 1987, July 1987, I did a degree in accounting and finance. And I mainly did accounting. I was doing some forensic accounting work, actually at a stockbrokers in London called TC Coombs, which was a bit of a bucket shop, to be honest. You've all seen Wolf of Wall Street. Well, it wasn't like that. But it was... They actually went out of business in the 90s. So there was a lot of, it was still with Big Bang and deregulation, it was a bit of the Wild West out there, and some slightly dodgy activity went on. But over time, people got weeded out. So I worked for a stockbroker then, and I was there during the 1987 crash. And I don't know if anyone went through that, but it was quite an interesting time. Globally, it affected New Zealand badly, and New Zealand actually still carries the scars of that from an investing perspective, and has actually driven a lot of the behavior here into property and away from stocks. And it's just starting to get over that. So I got my first scars there in 1987. Then I went traveling for it, and I came back to London in 1989 and started working for investment banks, which very much, that's what a trading floor looked like back then. Look at those lovely big monitors. It was fantastic. No mobile phones. It was great stuff. And I spent 11 years working for investment banks, trading in a range of areas, starting off in the derivatives market, so swaps, which for those who don't know what those are basically exchanging flows of fixed interest for floating interest. And then I got into global trading. But I also had done a lot of risk management, risk analysis, and building models. Back in those days, we built risk models on something called Lotus 123, and it used to take an hour every morning to work out what our position was. We would press a button, and then an hour later we'd get an answer, and you could do that now in about a millisecond. So it shows you how much the technology has changed. But it was an exciting time. I traded mainly global currencies. What's known as spot currencies, where shouting and screaming, or people are shouting and screaming at you for prices the whole time. And then later in the 90s, I got into proprietary trading, which was actually taking more longer-term bets and moving away from short-term trading to longer-term investment, which actually was about 3 days instead of sort of 90 seconds. So you can see that when you're trading, it's all about buying and selling over a short period of time. Investing is a completely different proposition altogether. Investing suggests something that has a longer-term focus. I want to just give you 3 examples, especially for newbies, but also older investors. You should always be a little bit careful of the smartest guys in the room, and I want to give you some really interesting examples of what happened in the late 90s and the early noughties. In the late 90s, there was a hedge fund called Long-Term Capital Management. Now, this hedge fund was known as the finest finance faculty in the world. It had 2 Nobel Prize winners. experts in modeling, in understanding risk, in understanding the ability to arbitrage, to basically make trades which really were almost risk-free, where you found different products that actually had similar characteristics, and you could buy one and you could sell the other, and you could make the spread in between. Unfortunately, that went a little bit pear-shaped as we got to the late 90s, and we had a few global financial crises, and they had liquidity squeezes. And what these guys unfortunately got caught with was one side of their trade had a liquidity squeeze, i.e. people weren't willing to buy or sell that particular product, and the other side didn't move. So suddenly that small little arbitrage, that small profit that they saw disappeared, and they lost $4.5 billion in literally a week, just vaporized. And it was a great lesson. It was the first sort of really big hedge fund collapse that we saw in the 90s, to show you that actually, even if you could find a little way to make a little bit of profit, you were still very much exposed to what we know now as leverage, which is basically where you've got too much money in the game and not enough capital to protect yourself. The second one, which is also very interesting, is a company called Enron. Now, this was a company that actually came from the 1930s and was built around natural gas and electricity utilities in the US. And they grew and grew and grew through mergers and acquisitions over time, and built themselves into a huge company with revenues of $100 billion a year. Absolutely massive. Between 1996 and 2001, they were named the US's most innovative company. Now, what was really innovative about them was their accounting protocols. And what they did is they created these structures, which we know today as special purpose vehicles and off-balance sheet vehicles, and they had stuff all over the place. So nobody really understood how they were valuing what was quite a complex market, and the utility markets are very complex and quite difficult to price. Anyway, they went bust, and their share price went from $90 to zero in 12 months. And it's a classic example of a company that looks on the face of it to be fantastic, but actually has quite complex accounting processes. And eventually that came unstuck. And actually, what was interesting about them is they had a business in fiber technology. They were trying to buy up all the fiber in the US. Now, actually, if they'd done that, they would have been incredibly successful. So it's another example of also sometimes good ideas don't always work out. Now, my third example is a bit more recent. This is from 2007. So everyone aware of the global financial crisis? Global collapse of the financial system almost. In 2004, these five investment banks, which I've called the famous five, got together with the Securities and Exchange Commission in New York and made the case that they should be allowed to self-regulate. In other words, their argument, which was quite simple, there's no way we would do anything stupid. We wouldn't put our companies at risk, we wouldn't take too much risk, so you don't need to actually monitor us, and we'll look after ourselves. And they got that signed off. And immediately after that, the leverage almost trebled in terms of the amount of capital that these guys were holding against positions they had in the markets. And some of you may have heard of Bear Stearns and Lehman Brothers, because they don't exist anymore. They went totally belly up, and they nearly took down the whole global financial system. Instead, what they got was a $700 billion taxpayer bailout. Lehman's and Bear Stearns disappeared, Merrill Lynch was bought, and Goldman Sachs and Morgan Stanley hoovered up a few other people. But it was a major cataclysm. And again, it was a great example of where you had the smartest people in the room saying, hey, we can do this differently. Trust us. We won't do anything silly. And eventually you end up with a huge disaster, which still is impacting Europe. You know, the effects of the 2007 global financial crisis are still impacting Europe because they never really dealt with the bank debt. So that might seem all a bit kind of highfalutin, and what's the interest in that? But actually what it does is it gives you lessons about really fundamentals, which I'll come to, but also timing. Timing is quite important. The peak there is of the NASDAQ in 2001. So the NASDAQ is basically technology-laden stocks. And what's quite funny is when we think about investing, I mean, there's no doubt, and we'll come to that in a little bit, investing on a regular basis is absolutely the way to go. But sometimes you inherit or you get a lump sum and you think, oh, do I stick that into the market now? Now, when I left the financial markets, it was right at the peak of that curve. But at that time, sort of early 2000s and late 1990s, everything was about tech. So I thought, hey, I'm young, I'm going to put all my money into growth stocks, which I did, and tech stocks. And I kind of thought, well, who cares if they go up and down? Unfortunately, a lot of them went down and they never went back up again. So that was slightly unfortunate for me, but never mind. But the timing piece is really important. Now you can see, if you've been investing blindly over that time, who cares? If you go back and look at the S&P now, the Dow Jones, and look at where they are now, if you've been investing over the long term, you're actually at the peak of the market. So timing is very important. And timing is also important in terms of technology. In 2001, I invested in a company in the UK called ZTech Power. And they were basically the world's first company to develop hydrogen fuel cell technology. Now, have you heard about that? Because it's being talked a lot about now, like it's the great new thing. Well, it was done 20 years ago. And this company was due to float an IPO for $1 billion. There's some big investors in it, big players. 9/11 came, bang. The thing blew out. They couldn't raise any money. 3 months later, it was bust. So it's a very good example that actually not all good ideas always turn out the way that you would like. So fundamentals, you cannot get away from this. Cash is king. As a company, you either need to raise money through equity, so investors, debt, in terms of banks lending you money or bonds, selling stuff, so your revenue, or just retained earnings, cash you've got in the bank. It doesn't matter who you are, without cash, you're going to get stuffed. And what we saw from a lot of those examples is those companies ran out of money. And it still happens today. And in New Zealand, I can give you, if I think of 4 examples in recent years. So Wynyard, which was a local Christchurch company, which sadly I was invested in. I actually picked some real dodgy companies, which was a great company, but they got their cash flow model completely wrong, and they ran out of money and went bust. Dick Smith, Mainzeal, Feltex, all good companies that got their cash flow management wrong, couldn't sell themselves, run out of money, kaboom. So when you're looking at individual investments, and when I look at any company, I always say, how much cash have you got? The first thing I look at on a balance sheet is how much cash does this company have? And we see it time and time again. It's one of the hardest things in a business is to manage your cash flow. So fundamentally, that matters. Disruption. So as I was talking about ZTech Power, now disruption has always happened. People talk a lot about the Kodak moment. Instagram with 15 people brought Kodak to its knees with 75,000 employees or whatever. Yeah, but that's not the whole story. We've always had disruption. The steam engine, the Industrial Revolution, horses to cars, radio to TV, print to internet. It always happens. So you can't be afraid of disruption. But I think, as Kendall mentioned, it's always good to know, what are people buying? What are they spending their money on? I remember going on a holiday once to Miami, and one of my kids was going, let's go to the Apple store, Dad. So we went along, and it was absolutely packed. There were queues coming out the door. He goes, we should buy some Apple stock. He was quite right. It's that sense of understanding where the drivers are, and that leads you to make some of those investment decisions. But you'll never get away from the fact that over time, technology will change, and it's something that we all have to grin and bear. Risks. When you're trading or investing, there are always going to be risks. Things will always happen. And if you look here, cyber, terror attacks, they're kind of new, but again, they've always been around in some form or other. Fraud has always existed, whether it's cyber fraud or paper fraud. Financial crashes. I've been through 2 crashes, still here. It happens. It usually happens every 14 to 18 years. It's a cyclical thing. Nuclear standoff. We talk a lot about the climate emergency. A lot of us grew up with the nuclear emergency. Didn't happen. That's cool. And environmental disaster has always been with us. Those risks are always there, and you'll never get away from that, and it shouldn't put you off investing for the long term. So, what does investing for the long term look like? That's not me. It's my favorite position, actually. I put that up there because in a way, it's easy to get sucked into short-term stuff. Read the papers, read the internet, what's the latest story, get very excited. But actually investing is totally the opposite of that. Investing is actually sitting back, reading a book, and actually not paying a lot of attention to your stocks. Now, some people like to manage their stocks a little bit more, but you're always going to get caught out on timing. You're always going to get caught out on disruption. And taking a long-term view means actually investing regularly. Yeah, of course, updating your views on where you think the world's changed. Do you want to change sectors? Do you actually want to invest in a new sector? I mean, some of the healthcare tech that we're seeing, some of the water tech, AI, robotics, that's great. But really, the art of investing, as opposed to the art of trading is a different story. Trading is manic. Trading is being plugged in 24/7. That's not investing. That's a different game altogether. That's about generating profits on a daily basis. Investing is about a long-term view of the world and trying to allocate your resources with a view to some kind of future event, which might be retirement, buying a house, or buying a boat. So, to sum up, and I'm glad, Kendall, you said that, the only right time to invest is now, because it's so easy to put off this stuff. But actually, because it's not a short-term thing, you just have to say, I'm going to start investing like I'm going to start saving. Exactly the same process. It is a long-term process. It's something that requires thought and commitment, but over the long term, it pays off. The numbers always show that, and it shows through feast or famine. Long-term investing always pays off. Try not to invest lump sums in one go, because then timing does matter. So actually, if you take a more, if you do have a lump sum, I would, I would split it up. And take your time in terms of putting it into particular markets. Diversification is good. Sometimes I actually think I've made most of my money out of property. Unfortunately, that's been the story of the last 25 years. And when I moved to New Zealand in 2002, it's like property's a sport here. It was quite unbelievable. It wasn't like that in the UK so much. Disruption is a fact of life. The world is going to change. But again, with the right diversification and long-term approach, that shouldn't matter. And I think actually trust the experts. As an expert myself, I was always like, I'm not paying fund managers to do something I can do myself. But actually, I'm not a fund management expert. I was a trading expert in global markets. They're completely different skills altogether. So I've come to the point of view, actually, I'm just going to invest regularly and leave it to the fund managers to do their job. I've done an awful lot of startup investing, way too much. And what I've learned out of that is good ideas don't always make good businesses. It's a tough thing to do. It's a tough thing to get right. Look at companies like Google. There were companies before Google who had brilliant search engines. There were companies before Facebook, MySpace, Bebo, Friendster. Apple failed twice. It takes a long time to get things right. And sometimes good ideas take a long time to come to fruition. So sometimes, that space is not where you want to be investing your dollars unless you've got a lot of money to spend, but you may not get it back. And cash is always king when you're looking at businesses. How much money have they got? I think this is really great. When Sharesies asked me to come and talk, I thought, great, this is something we do need to talk about, because I think financial empowerment is really important. The democratization of finance is crucial. One of the organizations I'm involved in is Ohu Development, where we're doing crowd-funded property development. Again, trying to say, hey, even if you've got $100, you can have a stake in a commercial property development. And I like this is the same thing with shares. And actually, if you're going to change the way companies behave and act, and I've done a lot of ethical investing. 20 years ago, I was really into that in the UK, helped set up companies like Truecost, which monetize ecosystem services and externalities. There's a lot of talk around divestment. I actually think it's the wrong way. You want to be investing in these companies and using shareholder power to change the way companies behave. So I think it's fantastic that this type of approach is being taken. It's opening up the investing framework for everyone to get involved, and I think that will change the way that companies operate. So that's a very good thing. So thanks everyone for coming along. Happy to answer any questions. As you can imagine, I was around this at the beginning. I have been involved in the monetary reform movement for 20 years, starting in the UK, looking at alternative currencies, complementary currencies. In some respects, Bitcoin was a digital version of that. I've never bought Bitcoin, and I've never got involved in it. I think it's likely to I do worry about everything being digital. Really do. I actually own gold, physical gold, which is locked away somewhere, not in my house. Don't come. Money is an exchange. It's a promise. It's an IOU. I can write you all out some money right now, which will say Bank of Raf, $5, and you'll take it because you know that you come to me, I'll give you $5. That's all a bank is. That's all that money is. The problem I have with Bitcoin and other cryptocurrencies is they're just taking really what is a paper version into a digital form. I worry about the security aspects of it. I worry about the energy used to create it, when actually I can create money on an Excel spreadsheet for no energy. Blockchain I'm more interested in terms of the security aspects and the distributional approach to that. So I'm open-minded about that. But this is actually something I'm not getting involved in because it's the sort of thing I would have got involved in 20 years ago and would have done my shirt. So I'm happy to sit back and see how it develops. But again, you have to look back and ask what problem is it solving. That's really the key thing. Having customers. That's the key thing. If you can have the best idea in the world, but if you can't find anyone to buy the product, then you haven't got a business. So a good business is something that meets some kind of need out there. Even if you create the demand yourself, which lots of businesses do, but you've got to have customers, and that's it. That's the bottom line. So a lot of companies can spend a lot of money getting those customers, and if you look at the Silicon Valley business model of the last 10 or 15 years, it has been spent an awful lot of money to acquire customers, build platforms. We don't really have that in New Zealand. Our angel market is very thin. Our secondary capital markets are very thin, apart from Zero, and a few others, we haven't really sort of hit any winners, and a lot of that's just down to that lack of capital. Silicon Valley, if you trace the chains of capital and investments and sales and reinvestments, comes from a very small pool, but they've been doing it for 30, 40 years. That's a good question. I think it's completely a personal preference. I probably have, probably 40% in commercial property, which is quite a high weighting, but actually it's been the best earner in New Zealand for the last 20 years since I've been investing. I would probably have about 40% in a balanced fund. So it's some probably blue chip equities. Enron was a great blue chip, by the way. So blue chip equities and a mixture of bonds. And again, actually I've invested in bonds for 20 years in New Zealand. They've actually been one of the best returns that you can have, not so much now. So probably, 80% in property and balanced funds, maybe 5-10% in commodities and the other 10% in cash. I've been renting for the last 3 years in Christchurch, having sold out a property that I owned, and probably it's been a much better deal. So in terms of and this is the Gareth Morgan argument, in terms of the cost for me renting, in terms of what I'm paying rent and the place I'm living in, it's probably about a 2 to 3% return to the landlord, but they're taking a long-term view. So for me, it's cheaper than buying the place and getting a mortgage on it. I think housing, it totally depends on your personal circumstance. I wouldn't make that your priority. Sometimes renting is good because you don't want to put down roots somewhere, and there's high transaction costs for buying property. So you buy a property when it's somewhere either you want to keep for a long time or that's where you want to live. And then you get huge benefits from owning your own home. And so if you think, yes, it might be 2% a year cheaper to rent, that 2% is a premium in a way to own your own home. And you can put your own paintings up and paint with colours, whatever you like, and all the rest of it. Spend your money locally. Has a huge multiplier effect. That's the thing about local currencies, which we looked at here at council. It wasn't really the right, we had too many other priorities. But local currencies in places like, say, there's a lot in the UK, the Brixton pound, the Bristol pound, issued mainly by retailers, and then people spend back into the local market. It has a huge multiplier effect rather than spending money outside the country. So the more you can spend locally, the better, because it has huge knock-on effects in terms of employment, and that's really important. Buy local property. And determine the outcomes there. So to give you an example, Collett's Corner in Littleton, which I've invested into, the whole point of that is actually building a commercial / residential property development where the shareholders will take a lower return, certainly in the early years, because they want the thing to succeed. So the traditional development model is basically just rip as much of it out as you can. It's the private equity model as well, which is what happened to Dick Smith. It's a great story to read about. So all of these things are trade-offs in terms of what your return is going to be, where you want to invest your money. If you want to invest your money in ethical or ESG, as they call it these days, there may be trade-offs there as well, but you're getting something back for making that investment. So everything's about weighing up your opportunity cost. That's what investing is all about. Do I put my money here, or do I put my money here? Do I spend my money here, or spend my money here? Yeah, so this was, the late 80s and then the 90s. So we had, the thing about working in financial markets, you had the best tech that was going anywhere. And so we had great information through charts, so a mixture of technical trading and then fundamentals. So we had economists that sat on the trading floor and interpreted data today which no one will pay any attention to. So, like an employment report or an inflation report, GDP report, that could move markets hugely. These days, everyone's like, because everything is so transparent. It takes a lot to really shift things these days. Everything is priced in to the markets. You kind of think, they cut interest rates, Kiwi's going to go down. Well, no, because everyone knows interest rates are going to be cut. Back in the 80s and 90s, you had a lot of asymmetric information. Stuff just happened and shifted. Countries would devalue by 10, 15% on a Sunday night. So markets moved hugely. We had banks collapse. I remember when Barings collapsed one weekend, and stuff happened that doesn't really happen now because of the huge amount of regulation and the huge amount of transparency in markets. You'll still have companies that go bust because they don't manage their cash properly, but generally we don't have the sort of unexpected events that we did have then. The 90s was littered with one financial crisis after another. Asian financial crisis, the Russian financial crisis, the Mexican financial crisis. Now we have a completely different financial system. We're kind of there. If you think, one of the best books written about this was by a guy called Fred Harrison, who's a Georgist, so land value tax proponent. He wrote a book in 2005 called Boom Bust, House Prices, Banking and the Depression of 2010. You could see that coming. We're probably getting close to where we should be seeing some kind of a recession or slowdown or some kind of crash of sorts. But the global market's completely different, and you can't analyze it today in the same way that you always have done. We're reaching a very mature point in industrial economies, which has been developing over the last 30 years since Big Bang in the mid-1980s, but also post-World War II with the Bretton Woods global architecture from WTO, IMF, World Bank. And we now have so much debt in the system that actually nothing that anyone does shifts the dial. So cutting interest rates doesn't make a lot of difference. It just makes the debt easier to service. A good example is to look at Japan. Japan's debt to GDP ratio is 300%. Makes no difference. Watching the painful stuff that goes on in Parliament here about this wretched 20% net debt to GDP ratio, it's completely irrelevant. It's completely irrelevant. It's not even close to irrelevant. It's completely irrelevant. It makes no difference at all. The only thing that matters is inflation. That's the only thing you need to watch. And inflation really is a product of capacity in the economy. So as long as there are people and resources, that's the main thing. So this whole debt stuff's irrelevant. So we're getting to the point where globally, and this is what monetary reform is often about, is that our debt will become monetized. It will just become part of the money supply. And we will eventually tend to interest rates of zero. And stuff will get washed in, stuff will get washed out. And the price of money will actually come down to nothing. So then it's really how much money do you have in the system to service your economy? That's really the key measure. And we're not there yet. So the next recession may be very different to what we've had previously. And that's another, all throughout history, we've always analysed the present and the future with tools from the past. They're not always the same things. We're evolving all the time. Okay.